Well, good morning, everyone, and thanks for joining me on this session today. My name is Sam Lau. I'm a portfolio manager on the Macro-Asset Allocation Team, and you may have just seen me in the pre-recorded session that preceded this on maintaining purchasing power. So given that was pre-recorded, we didn't have the early look on what the CPI numbers would look like, and we did have a bit of a surprise, especially on both on the headline and the core levels of CPI. But I think a lot of the themes still remain relevant to what we spoke about, and that's really about finding ways to increase income in this environment that we're in today. So in this session right now, I wanted to build on many of the themes that you've heard about throughout the client event and talk about how we can incorporate those themes into portfolios. And as a note, if you missed any of yesterday's sessions, you can catch the replays by clicking on the May 12th tab on the homepage. Also, you can access the resource library for all related strategy and fund materials for the session. So finally, I'd like to say that if you have any questions today, you can go ahead and submit them in this portal, and I'll answer them after my prepared remarks. So to begin, I'll provide an introduction on our Fixed Income Asset Allocation Committee, which we call FIAD for short. Then I'll take you on a tour of the process we employ during our monthly meetings and show you how we express thematic views through our portfolio construction. And then finally, I'll show you how we use non-traditional fixed income sectors to improve portfolios as one way to meet the challenges in the current environment. And to illustrate that, I'll use a handful of DoubleLine strategies to provide real-world examples of how you can seek to improve overall performance. So we can begin with an introduction to FIA, the Fixed Income Asset Allocation Committee, which is a framework that we use to manage multi-sector fixed income strategies. FIA is run by committee, where members have been working together as a team for an average of 19 years. And that reflects a stable, seasoned team that has applied a consistent investment process over that time. And that process centers around the philosophy that, one, active management is paramount to delivering superior adjusted returns. And that process begins with an assessment of relative valuations to inform our top-down sector allocation decisions. That top-down approach is coupled with bottoms-up security selection that ultimately is implemented by sector-specific teams according to the allocation decisions that were made at the monthly meetings. So here we have the FIA committee, and you can see that it's led by Jeffrey Gunlock and Jeffrey Sherman as the heads, as well as the heads of the various sectors in the blue on the left. And to the right of that are portfolio managers that support the sector heads, and each are responsible for their individual areas of expertise within the fixed income market. Every individual on this page, of which there are 20, are senior portfolio managers, and that doesn't include each sector's team of dedicated traders, analysts, and other PMs. So that's the brain power. Those are the resources, and that's the experience that goes into determining the appropriate sector allocations and security selection for FIA strategies. You essentially get access to every fixed income portfolio manager at DoubleLine through this committee. So FIA takes place formally once a month, where the output of the meeting are the decisions on what the appropriate sector allocation, duration, and credit exposures should be. To help make these decisions, the committee reviews macroeconomic data, has discussions on outlook, risk, and opportunities and valuation amongst sectors. After that, the FIA formalizes its asset allocation decisions. Then it's up to the team specializing in their respective sector to implement those changes. So let's see, now I'll take you on this tour, and for that, I will break out the process into sections to help illustrate how we reach our decisions. First, we take a review of the global landscape using a chart pack that we maintain in-house, and this chart pack contains snapshots of economic and market data over time, as you can see on the page here. And what I've done is I've pulled a few charts that we look at, and you can see that it covers a multitude of areas, including performance by sector there, global GDP, yields, spreads, labor information, income data, PMIs, currencies, commodities, default rates, and relative growth trends. So the chart pack covers a lot of ground, and it's just one chart shy of 100 pages in its most recent incarnation that we took a look at just a few weeks ago there. So at month end of April. So what this does is it gives us an objective view of the environment, and that serves as an additional input into our decisions on how to position portfolios. So taking a deeper dive here and focusing on one way to assess value, I've selected the relative performance trends of 4 fixed income sectors to provide a peek. Views like these are the ones that provide us with a quantitative assessment of relative valuation among sectors. And what we have in each chart here is a comparison of selector sector indexes relative to the US Treasury index over time. And around that relative growth line that you see, we also indicate the trend in the gray line and bands that point to sigmas relative to that trend. So starting with the top left there, you can see most recently the US investment grade corporate index appears a bit expensive relative to the longer term trend after rebounding in the second quarter of last year there. The sharp rebound there was most likely on the direct support from the Fed, given their participation in that part of the market that was somewhat unprecedented. And as a result, IG corporate credit rallied in response relative to Treasuries. And now they are back. Actually, they're past their previous high watermark now, and they are now more than 2 sigmas rich relative to trend. So IG corporates do look expensive using this measure. Moving over to the right there, we have the non-agency RMBS index, and we see a similar pattern with the dip last year and then the subsequent bounce, albeit with a slower recovery. But non-agencies still look cheap on this metric, and it's just off of the lower end of the range, and appears to have further room to run, at least to get back to trend. So this would signal a potential opportunity for the team. Next, we have the leveraged loan index, which is 1 sigma rich to trend, and it also looks like it's near the top of its historical range. Moving over to the EM index on the right there, and similar to non-agencies, it looks to have some value and further upside left based on this framework. So these are some of the charts that we go through to make our assessments there, and including the ones on the previous slide. Those together again provide an objective snapshot of data to help the team assess current market conditions. So next here, we turn to what I think is the most important part of the meeting, and that's the discussion amongst committee members. Here we start with an overview where each sector head discusses what they're seeing in their area of expertise. So we might start there on kind of the top left with Greg Whiteley, have him provide an overview of what he's seeing in the US Treasury market. And from that input, his insight, that helps us inform our views on how we want to position portfolios with regards to duration and interest rate risk. Next, we might move down and head to, let's say, emerging markets, where Luz Padilla will provide her sector overview on part of the U.S. market, similar to what you heard yesterday during her session. And then we keep going around and around the table until, well, today's virtual table, until we've heard from each and every sector head about the opportunities, the risks, and other factors that might influence the outlook on performance. And then we shift from having an overview to applying all of the information that we have just reviewed. And from that, we draw upon what we learned up to that point to help get a sense of the underlying themes that could impact performance. And that helps us formulate decisions about allocation changes. It also informs decisions about how we want to be positioned for duration, what type of credit exposure we want, how much credit versus rate risk do we want for this environment? And if our view is positive on credit, do we have a preference there? Let's say, do we have a preference to corporate credit, or how about non-corporate credit? And with that, which corporate credit is more attractive? Do we like IG? Do we like high yield, bank loans? What's the case for one sector over the other? And if we're going to add to a sector, the conversation has to steer to which sector should we reduce? So these are some of the many things that we discuss during the meeting, and that continues until we reach a consensus view on what the appropriate asset allocation and portfolio positioning should be for our outlook on markets. So thus far, I've talked about the top-down approach. The last part of the process is the bottoms up, and that occurs after the meeting is concluded. That's when the teams specializing in their respective sectors are responsible for the implementation based on the guidance that have just been provided at the monthly meetings, the monthly FIA meetings, I should say. So that's where bottoms-up credit analysis and old-fashioned security selection comes into play. You just can't buy what's in the index. You need to go through and sift through and find the most attractive opportunities. Now, when it comes to making these sector allocation shifts, the investment horizon we have tends to be longer than most, somewhere around 18 to 24 months in outlook. And it's really about trying to capture those macroeconomic trends with having the right asset allocation in place. Thus, you can see on this bar chart, it's fairly colorful here, that you can see that the allocation changes occur gradually to reflect this longer term approach. And here I have the historical allocations of our core plus fixed income strategy to serve as an example of these shifts. I've grouped the various sectors into cohorts with the blue shades beneath that thick black line running across the middle. That represents the sectors that are that comprise the U.S. bond aggregate, the Barclays U.S. aggregate. These traditional sectors generally have lower credit risk, but take on higher interest rate risk relative to their non-traditional counterparts. But also shaded in blue there, but also above the black line, those are the other government fixed income sectors that aren't in the U.S. Ag. Anything non-blue here is going to be non-traditional sectors, non-traditional credit sectors, I should say, and these typically have higher yields with lower duration. So you start with the green shades there, and we have structured products. Ken Shinoda talked about that yesterday, and those include asset-backed securities, ABS, CLOs, collateralized loan obligations, non-agency RMBS, and CMBS. And then if you move up into the yellow shades there, you have the blue investment grade U.S. corporate sectors. You might have caught Robert Cohen talking about that with Julia LaRoche and Jeff Sherman yesterday, and those are the high yield corporates and the bank loans that we discussed there within the non-traditional credit space. And then finally, we have EM in red. And that's when you heard from Luz and her team talking about that as well. So you can see these are all used within these portfolio allocations here. And what's created is we have a well-diversified portfolio that's currently comprised of roughly half traditional and half non-traditional assets there. And that's across 13 sectors. So it is fairly well diversified without any heavy concentration or reliance on one sector there. And you can see that over time, we've applied gradual shifts to this compositional mix between traditional and non-traditional as we sought to navigate the challenges that presented themselves in the current market over specific thematic periods. So if you look to the left of that chart there, back in, it looks like late 2012, maybe early 2013, you can see that we reduced interest rate risk while adding to credit. And you can see that through the color code that I provided there. So the reduction of the blue shaded area again, or you can just follow the black line. So this was a timely move, as you can recall, the taper tantrum that began a few months later in May of that year, which ultimately led to a surge higher in rates. So having the reduced interest rate sensitivity there certainly helped us navigate that thematic market. And then you can see there later that we reversed that positioning as credit markets began to look less attractive and volatility picked up. But then most recently, you can see that we added to credit in, let's say, the second half of 2020, as we found opportunities in the space based on sectors that had lagged in the recovery. So if you recall earlier that I showed on those relative growth charts that IG corporate credit did rebound fairly quickly and sharply, and that was likely on Fed support. What didn't was other areas of credit. So that's where the best risk-adjusted opportunity was to deploy capital. And that allocation change was funded by selling portions of the traditional sectors, those that had already recovered fully in price based on Fed intervention in the markets. So we sold traditional sectors of the market to buy sectors that still had further recovery value. So we sold high and tried to buy low. So you can see it's, through this chart, it's not just about loading the boat on credit in order to, seek out yield, but instead it's about thinking carefully about what the best allocation based on our outlook is, using that FIA process as a guide. And it's that process that has helped the team successfully navigate through numerous market cycles over the course of those 19 years working together as a team and using this process. So that's the overview of the FIA framework. let's move forward to talk about how we can apply it to create solutions for whatever the current challenge happens to be that's facing the market. And to illustrate what makes the current environment challenging, we'll look to the Barclays Aggregate, the intermediate term bond index or benchmark. And here we have historically low yields and coupled with historically high durations. And you can see that on the bottom left-hand chart. Yield to maturity has been on a steady decline since 1986, while duration has been on the rise since 2000, since around the global financial crisis, I guess we can say. And what you have here is an asymmetrically poor setup where the egg really will perform well under one scenario. It's a unidirectional type of trade here or investment, and that's if rates fall from where we are today, that's where it will really perform well. If rates don't move, then you get to basically grind out what is just off of historical low yields. And if rates rise even just a little bit, then you would have very low yield to offset that price depreciation, and you could face a negative return. So on top of that, in addition to being locked into that somewhat unattractive setup that you see here on this page, you also have to consider the challenges that the current environment brings. And that's one of low yields combined with the potential for rising rates, which we've already gotten a taste of since pretty much August of last year. And on top of that, you also have the specter of inflation that has been a common theme amongst the speakers during our client event. And that not only adds pressure to rates, but it also erodes income. So I'll talk a little bit more about the chart on the bottom right later in the presentation. But for now, note that like the chart on the left, the yield per unit of duration has also been on a steady decline since the 1980s, and that's not a good thing. So at DoubleLine, we have a history of creating solutions for our clients, and that's what I'm trying to show here on the schematic, where we have a range of FIA strategies to illustrate ways that we could address a number of investment challenges. With the exception of core plus fixed income there in the center, each of these strategies were created in response to reverse inquiries that we received from clients who needed help trying to figure out solutions to the market there. The strategies listed here increase in risk as you move from left to right. So let's start at the left here with the low duration strategy, which was designed for those seeking cash alternatives in order to increase income. You might have heard me talk about it if you attended the previous session. That was one of the strategies that I highlighted. And from there, you can continue to move right along the risk spectrum by incrementally taking on a little bit more duration and or credit risk. Along the risk spectrum path, you will encounter the strategies of Total Return Tactical and Core Plus, which are both benchmarked to the U.S. Aggregate. But these two strategies can provide more yield with less duration than the benchmark. And then to the right of that, you have Flexible Income Strategy, which has more credit risk for those seeking higher income. Opportunistic Income, which is on the far right, as you can see, says that it has all options on the table. So really, across this risk spectrum, the tie that binds all of these strategies together is the fact that they're all managed using the FIA framework by the FIA committee, using the same universe of fixed income sectors. The difference is the investment objectives. So using that framework, you can really create a number of different ways to approach whatever whatever challenge might be in the marketplace. So here I have the parameters of various strategies, and at a high level, I point out that each strategy has varying minimum and maximum weights. That's shown in the blue table there. That's dependent on the objectives. But you can see that each strategy invests in the same pool of sectors, as I indicated before. And those are listed on the left side of the page. Now, if you're looking for a cash alternative, one way you might be able to do so is via a low volatility, low risk strategy that generates attractive income. And to do that, you put together a set of investment guidelines that incorporate a lower duration and higher credit quality thresholds. And what we did at DoubleLine to meet that objective, we created the DoubleLine low duration strategy, and you can see the various parameters there on the chart. In turn, if you're looking for something that's more traditional ballast type of protection to the equity side of your portfolio, perhaps something that benchmarks against the Barclays Aggregate, then there's a way to do that with by still getting higher yields and lower duration. And we have two options here. The total return tactical strategy was developed in response to a request to have a lower duration profile product that was more akin to our total return bond strategy, which some of you might be more familiar with, but in turn using a broader investment universe that comes with the FIA framework. So a little bit more diversification across the credit possibilities there. And then if you move to the right of total return tactical, you have the core plus strategy, which can take marginally more duration and credit risk than total return tactical. So both of those have similar performance objectives, but they take different approaches to get there. So if your goal is to seek higher income than the AG, though, we also have a thoughtfully constructed portfolio of credit that might offer a solution. And that's the flexible income strategy that has more leeway than the other three strategies. So here's how we're currently positioned using non-traditional assets to meet our objectives. You can see that the total return tactical and core plus fixed income strategy in the center of the chart there have similar amounts of exposure to non-traditional assets, and that's indicated by the left-hand vertical axis. So looks like around 40 to 50% exposure to those non-traditional assets for these two strategies that are benchmarked against the US aggregate. And the US aggregate, you can see there on the bottom right-hand corner, it has 0% allocated to non-traditional. And that's because that's how I define the universe. Anything that's outside of the Barclays aggregate is non-traditional in this sense. But what you see, I guess, is in terms of duration on the horizontal axis there is that the AG has materially more interest rate sensitivity at nearly 6.5 years duration relative to each of the four DoubleLine strategies. And that's because the non-traditional assets, as you've heard, many of us speak about, they generally have less interest rate sensitivity than the traditional sectors. And this is a conscious decision to incorporate them based on an active management choice. And that's a way of controlling the amount of interest rate risk that we take and overall risk to the portfolio. So if you move your eyes to the top left there, you'll see the low duration and the flexible income strategies there. And they both have 2 years or less duration. And with that, you also have an accompanying roughly 70% non-traditional exposure, 75% or so to the low duration, and then 90% non-traditional exposure to within the flexible income strategy. So I've listed the yield and the durations and something called yield to duration as well in that last column there by sector. And that's the yield. The yield to duration is the yield of the investment divided by its duration. And this is a framework that we apply that indicates how much interest rate risk you can withstand before your expected return on an investment turns negative. But take note that this doesn't account for credit risk. So it's not perfect, but the yield to duration ratio does serve as a quick tool to assess rate risk. So you can notice that the Barclays aggregate, the ratio there is 24 basis points. And if you recall from the previous slides, I pointed out that this ratio wasn't very good. It's near a historical low going back to 1986. So today's level at 24 basis points suggests that if rates were to move up by 24 basis points, then your return will be zero, everything else equal. Now, if rates were to move by 25 basis points or more, then you could start seeing negative performance. So if you recall also, if you have photographic memory, you might be able to recall that that chart that I mentioned previously started out life with around a yield to duration ratio on the Barclays aggregate of around 2. Today it's down to 25 basis points. So a much less attractive position that it's in now versus when it was back in the mid 80s. So the higher the ratio, the higher the rate move an investment can withstand, all things equal. And I've sorted these sectors by yield, and you can see that you can get higher yields with lower duration by investing in non-traditional assets. The investment grade corporate credit index, which is the highest yielding sector if you're constrained to the AG, would give you a 2.2% yield with 8.5 years of duration. So perhaps there's more attractive opportunities outside of the traditional sectors and in the non-traditional areas. So if you recall, Mr. Gunlock spoke yesterday about diversifying away from the U.S. as a theme. So with that, we can look to potentially emerging market. And both, you can see here, both the sovereign and the corporate index have a pickup in yield with materially less duration, resulting in yield to duration ratios that are about double to triple that of the US equivalents. And additionally, a number of the sectors can do well if interest rates rise. Recall that Mr. Shinoda yesterday had a slide that showed how securitized credit can still provide positive returns during periods of rising interest rates. But again, I'm going to point it out again. Keep in mind that this framework doesn't take into account credit risk, and that's an entirely separate analysis that needs to be performed. So credit selection is obviously critical here, and proper analysis and due diligence can help mitigate the probability of default, reducing that credit risk. But I do think that credit is relatively attractive today, as we're in an improving economy, and that's generally supportive of credit risk. But you do need to analyze every CUSIP, every sector that you introduce to your portfolio to understand not only the added risk that it brings, but just as importantly, I would say, not necessarily more importantly, but just as importantly, how that risk integrates within your portfolio. So here are what the portfolio characteristics look like across these strategies that incorporate non-traditional credit. On the left side, we have yield to maturities. On the right, we have durations. So starting with the low duration strategy as the cash alternative option, that's shown in dark blue. It has a comparable yield to the U.S. aggregate, just slightly above it. Let's just call it the same type of yield as the U.S. aggregate, which is shown in the red bar, but it has that yield with only a fraction of the duration. So it's really punching well above its weight class. But you also have to keep in mind what you saw in one of the previous slides, and that's that the low duration strategy has roughly 75% of its allocation in non-traditional sectors. And that helps explain the higher yield and the lower duration profile. So the give up here is that it may see less benefit if rates rally, but the trade-off is relatively attractive income, low volatility, and a stable return profile. If you take the ratio that we just talked about, and then you divide the yield of the strategy by the duration of the strategy, you have a ratio of over 1 here. So it's much better positioned than the A based on that framework. Next, we can move into the intermediate term bond strategies, and here we have the total return tactical strategy in gray and the core plus strategy in yellow. These two are benchmarked to the AG, and they both out yield the U.S. aggregate by about 1% or so each. The durations on these are both lower by roughly 2 years, where the duration on the AG is about 6.4 years, and it's versus the roughly let's call it 5.5 years of duration on these two AG improvements. And I'll call them improvements because both strategies do have a better setup from an income generation perspective, and they also do so with less risk. And thus you see in the yield to duration ratios that are roughly double that of the US AG. So finally, we have the flexible income strategy, which by far has the highest yield. At 4% or so, and it's given that it's allocated to roughly 90% to non-traditional assets, that's not too surprising. So it's definitely not designed to be a ballast to your equity holdings, but if you are looking for something that yields twice that the AG has, then here's a thoughtful option that's managed by DoubleLine. So to pick up on some of the current parlance of the younger investors out there, if you have diamond hands and you can stomach some volatility, then this might be an option. So here we can see that the non-traditional exposure is not synonymous with below investment grade ratings. And at the strategy level, aside from flexible income, each of these strategies carries a single A minus rating currently. So they're firmly investment grade rated despite having non-traditional sectors of the market within the portfolio. Now, flexible income is knocking right there on the investment grade credit door with a rating 1 notch below IG at BB+. So it's still, it's not too far into the depths of credit in order to get that 4% yield that you saw before, but really it's just at the near the top there. So looking at the chart on the left, that shows you each strategy by broad rating bucket. You can see that those improved yields on each of those strategies are largely achieved while still investing in investment grade rated securities. So Again, flexible income deviates here slightly, or it does deviate here because of its objective, but the objective again is to get higher income, and to do that in this market, you need to go lower in credit quality. So that's the understanding and the trade-off there. So 50% investment grade rated exposure for flexible income, which is the light blue bar, and 75% or higher in the investment grade rated exposure for the other three strategies. On the right-hand chart, I provided a more granular look by credit rating. You can see that most of these securities are in the AAA bucket, so the creme de la creme. 40% of those securities in Core Plus are rated AAA. And look at that, 50% AAA in the low duration and total return tactical strategy. So very high credit quality here. There's also this category that you'll see that might be unfamiliar, and that's called non-rated. So non-rated also isn't synonymous with below investment grade. It just means that these securities don't carry a rating. It's where the issuer has decided to forego the credit rating because, one, it improves the yield to the investor because you don't need to pay for that credit rating by the agencies. And two, the investors of these transactions typically are, or at least should be, capable of underwriting these securities themselves. So at DoubleLine, we don't take the ratings assigned by credit agencies at face value, especially not after what happened in 2008. Our investment teams underwrite each security that we invest in using their own methodology to determine credit risk. So here's the sector composition that we have in place to meet these objectives. The lower duration strategy on the left is nearly 80% in non-traditional credit. That's the green, the yellow, and the red bands. I tried to maintain that same theme as you saw previously with the historical target allocations. You see here that about 20% is allocated to traditional sectors, with just over 10% to government securities and the remaining to IG corporate credit. So the credit risk that we take in a low duration strategy is 60% to structured products, which includes non-agency RMBS, CLOs, ABS, and CMBS. We also have 5% to bank loans and 15% to emerging markets. And looking at this, you might be wondering, how is it possible to have such a large allocation to credit if low duration is meant to be a lower risk strategy that could serve as an alternative to cash for those seeking a bit more income than zero? Now, recall from the previous slide that 80% of the portfolio here is investment grade rated, and of that, 50% of the total portfolio exposure was rated AAA. So again, very high quality credit. Also, the securities in the portfolio here are shorter duration and maturity, which is another way of managing risk. So in this composition of credit exposures, that's how we feel best achieves the strategy objective today. Move over to the right. Sitting in the middle there, you have the portfolio allocations of the two intermediate bond strategies that, again, are most similar to the Barclays Aggregate based on the benchmark. So you can see that we have a little bit more, or we have more government exposure here than low duration, with 50% or so in Treasuries and agencies in the total return tactical strategy, and roughly 45% in Core Plus. For total return tactical, the bias is going to be within that government sleeve towards agency MBS for the government allocation. And again, that's a nod to its total return bond strategy heritage. Now for both, instead of the 30% allocation to IG corporate credit that the US Aggregate has, we chose to diversify the credit exposures across multiple sectors of the non-traditional market, including EM, high yield bank loans, and again, you're going to see in green, the structured products credit. And what results is, as we saw previously, is the taste great, less filling. That's what we like to say at DoubleLine. You get more yield with less rate risk. So finally, we have the high income objective with the flexible income strategy, which on the surface seems to have a similar sector composition to the low duration strategy. But we just took a look under the hood on the previous slides and saw that low duration strategy has 80% exposure to investment grade rated securities versus 50% in flexible income. So in order to obtain that north of 4% yield to maturity today, flexible income has to go into some lower credit quality assets. Again, that's the give up. So while the percentage weights of these sector allocations look to be the same, the underlying securities may have different profiles. But for all of these strategies, you just can't load the boat on higher yielding credit in the search for income. If we did that, you would expect much higher yields than we currently have, but you would also expect much greater risk. So instead, at DoubleLine, we don't like to cross the double lines of risk, as you probably know. So we seek to obtain the best risk-adjusted return profiles, and to achieve that, you need to consider how risk integrates within your portfolios. I'm going to skip this slide just for time here, and wrap it up with a summary. So to summarize here, the FIA process is one that we've been using for several decades now, to help clients navigate markets. The portfolio managers that sit on the committee have worked together as a team for 19 years, using an approach that is centered around active management of sector allocations and rigorous security selection. We apply a top-down, bottom-up approach to make sector rotation decisions that draw on a host of macro and market indicators, and putting all that information together is the expertise of the seasoned team. To meet the challenges posed by the current market environment, one where you have a double whammy of near historically low starting yields and a potentially rising rate environment, we do have conviction here that incorporating non-traditional sectors of the fixed income market can improve overall risk-adjusted performance. So the common theme here is that income with less interest rate risk, which in the recovering economy that's been funded by government debt, credit risk is more attractive than rate risk. And I think the key to navigating the rest of 2021 is going to be managing the amount of interest rate exposure you have in your portfolios. But do remember that this requires a careful understanding and implementation of risk that really begins with having the right sector allocation in place for each particular environment. And that itself requires the understanding of how each sector and security interacts with the rest of your portfolio. And we call that risk integration. So to sum it all up, adding non-traditional exposures can improve your portfolio yield and duration. It can also diversify your traditional bond exposures, and also, as well as offer more opportunities for success in the challenging environment that we face today. So I have seen that we've had a few questions here. Let me see if I can see first if there's a way to approach this here. Bear with me, I'm not very good with technology, as you've probably found out. Let's see, are long duration treasuries the best ballast to a portfolio primarily taking credit risk? That's the type of question today where it depends on what type of yield you're receiving. And right now we've seen, if you're talking about long duration treasuries, I suppose you can be talking about anywhere from the 10-year out to even the 30-year of the curve. We have come off of the lows on let's just use the 10-year as an example. We're sitting around 165, and I'm not quite sure that you're really getting enough compensation through the yield for taking on over 9 years of interest rate risk through the duration today. I think there's other ways, if you're trying to take on credit risk, to think about acting as a ballast within the portfolio by think about risk integration and the different types of credit risk that you might be able to take in there. So, having some corporate credit exposure that might have different sensitivities to the market than consumer credit, that might be one way of thinking about diversifying and providing a ballast within the portfolios while still getting paid by it. One of the things that we've seen, since the pandemic, and even really preceding the pandemic, is that many areas of structured products have seen improved underwriting guidelines that have occurred post-GFC based on the number of the regulations that have been taking place in those areas. So you've seen improved underwriting, you've seen improved structures as well, further protecting investors from potential risks of default there. So overall, the consumer credit market, as measured through structured products, seems to be in a pretty good place. They're also a little bit less leveraged, especially relative to some areas within corporate credit. Definitely, if you're thinking about taking corporate credit risk, something I would probably avoid is IG corporate credit, which has it's near its historically low yields and spread relative to a duration on the index, which is somewhere around 8.5 years today. So you're definitely not getting paid. And I think that's one of the key considerations is whatever you're adding into the portfolio, you want to make sure that you're getting compensated for whatever those risks are. And I just don't think you're really getting that in some areas of corporate credit, as well as, quite frankly, some areas within the Treasury market. So, but if I'm going to take in, those types of ideas where you want to have true ballast, then I think, Treasuries could be a place within the portfolio for the only reason that they are the asset class that does show true interest rate duration. Let's see here. Given that many credit spread products are near all-time tights, is now a good time to increase credit risk? I think it really depends on where you're looking within, again, credit. A lot of the yields that I talked about there and durations are just based on the index alone. And you can't just invest in an index because you need to get under the hood and find out what you're investing in. There's a very big differential in the amount of yield that you can get. Let's just use the high yield corporate credit market as an example, where you're getting, you're probably getting paid a little bit more appropriately as you go down in the credit sector. So you really have to go through there and see which part of the credit curve you're looking at. In addition to that, within sectors of each corporate credit market, each one is going to have a little bit different return risk profile as well. Some had the direct benefit of a reflation story that might have caught the bid early on in the economic recovery. And there's others that have lagged that might still show additional value as the economic recovery continues. So those are some areas that you could think about looking to increase credit risk. And one of the things, we've talked about securitized credit. Securitized credit, there's other areas that are much more esoteric, that are less trafficked by retail investors especially. So they're a little bit harder to access, and typically with that, you get some type of premium that just that accompanies that, because they're harder to analyze, they're harder to invest in, just because most investors can't get access to it again, especially through a ETF or something. Instead, it takes the relationship that our teams have built with our trading counterparties, and also it doesn't help to have size there. Size matters when you're fighting for bonds. A lot of things that we're hearing from our trading teams and our portfolio managers is, given the relatively quick recovery across many parts of the market, it's a food fight out there. So it does help to have the reputation and have the ability to really get out there and access these credits. Let's see here. So I have another question here. How does the supply picture, I think this might be the last one. I see I'm running out of time. How does the supply picture today look in short duration structured products, particularly ABS? Is supply beginning to come back, and how does that look moving forward? So across the structured products, and I think Kenny might have mentioned this. If not, again, I encourage you, if you didn't catch that, I encourage you to tune in again through the replay that you can click through the link on the product or on the portal's homepage there. But short duration structured products can be a little bit more difficult to access. Short duration products in general, just because as they amortize down in the securitized market, there are certain sectors of the market like CMBS that might have had a particular lull in the availability of short duration product based on the original origination date of those particular products. If you think around post-GFC, a lot of those products, you saw less issuance there. So you fast forward 5 to 10 years, after that period of time, you're bound to encounter a lull based on that lack of issuance. But one of the things that we're seeing, particularly in the RMBS market, the non-agency RMBS market, is that we're able to create new securitizations using existing loans that may have some may be seasoned already. And those might have a shorter duration profile. And then within ABS, there's many more options, I would say, there, just given the breadth of options that you have for the various consumer products within there. Not all of them, we take a look at, but let's just say if you were to look at some student loan financing or some some SoFi type of loans, or even, if you have the appetite for it, which we don't necessarily have, but credit card and auto ABS tends to be shorter in duration as well, as opposed to some of the non-flow or the more esoteric products within ABS that Andrew is probably talking about concurrently. So I would encourage you also to check that out to my session here, since I'm guessing since you asked this question, you participated in mine and not listen to his, but you might want to check out his on ABS and as it relates to infrastructure. Some of those hard assets there might have a little bit longer duration profile, but there are options. We still have a heavy allocation, as you saw, to structured products within the low duration profile, which is targeting the shorter duration type of assets there. So while overall finding good assets are always difficult, if you have the resources to dig through the available supply, you do find attractive opportunities still today. So I see that I'm over time. I'm not even sure if we're still on here, and I might have been talking to an empty audience, but if not, thanks for everyone for joining me today. Hopefully you found this session as well as our virtual client event to be useful. Please don't forget to rejoin us after the break, where DoubleLine CIO Jeff Sherman is going to be providing his thoughts on the equity markets, not just here in the US, but globally. So thank you all for your support of DoubleLine. Good luck and goodbye for now.